Welcome. Welcome, everyone. I'm Angelo Robles. Today, from Boardroom to Backbone, mastering high-stake exits and infrastructure, primarily energy, behind AI. Our special guest today is Paul Burgon, managing partner of Exit Ventures. He's one of the most experienced, really special guests from one of my favorite states, Utah, that we've had on this subject that I want to do more of. A lot of our families are business owners. A lot of you are active allocators in businesses, and understanding your optionality as well as the psychology behind exits coupled. And I know it sounds totally off track, but Paul is he's a polymath. He's diverse. So besides business exits, we're also going to talk almost like changing effectively 360 about halfway through the interview to basically somewhat on energy and infrastructure. So most families, I think they see strategic exits as kind of a financial event, but in reality, they're also very emotional. They're political and very deeply always personal. So in today's environment, I would even argue potentially, depending on the scale of the business, geopolitical and infrastructural, if that's my own word, so to speak, that I made up. So Paul sees things, as I noted, through unique dual lens as an expert, and trust me, in strategic exits for family-owned businesses and portfolio companies, but also a top-tier investor, as I noted, in clean tech, sustainability, and real-world energy systems. And I would even say the word also with an S, solutions. Paul, on that wind up, hello, welcome to the show.
Thank you, Angelo, for that. I'll have to update my resume with your compliments.
Well, thank you. It's a pleasure to have you on. Great to be connected to you. When I was out on the West Coast during the Milken conference, we connected really not soon after that. And actually this year, I even have been to Utah, but sadly I didn't know you then. Otherwise we could have done an in-person visit. But here we are now. Look forward to my members learning and sharing from your knowledge. And then eventually, perhaps a couple of weeks after the fact, I'll make parts of this more publicly available. So why don't we start? I'm going to start with a little bit of the psychological angle. What are the top psychological pitfalls that families face during a major exit?
Yep. Psychological, emotional. I prefer the term emotional because that's what you had mentioned before. And I think it is a highly emotional aspect. To sell the family business there's a few things. One, you have a sense of identity, right? That where the family, this is the way the family has, and I'm talking about the business, the primary family business. It's how it's generated its wealth, right? We're the family business. There's a lot of family identity and individual identity that has been built around the family business. You have differing opinions of when to sell and if to sell. And then you have differing opinions on the best way to achieve that end, assuming that the majority actually decide to go ahead to sell. There's no easy answers in any of those topics, right? And so unless there is a patriarch or a matriarch that's firmly in charge of that decision, even if there are influencers with the children or advisors, the board that are actively involved, which they probably should be, you have a highly emotional decision-making process. And so just a couple of thoughts on your question. One of the key questions would be when to sell. And that depends on a bunch of different factors. And I don't know how much you want to dive down into this right away, Angelo, but just at a high level, and then we can dive down deeper if you'd like. But the process of when to sell depends on the aligned priorities and values and needs of the family. And that's not something that's going to be the same for, that's not going to be the same for any of the families that are listening here in this podcast. So what I would suggest is when you're thinking about the time to sell, there's the time to sell for the family and there's the time to sell for the business. Those can be very different topics, but I would try and get consensus on the right time to sell the business as well as the right time to sell for the family and what that means for the family in terms of income, capital gains, essentially identity, sense of continuity. The family business, as you know, provides employment opportunities for usually many of the family members. It's not just income, but it's training opportunities. It's employment, validation and acceleration through that family business by taking on responsibilities that may be greater within the family business than they would be otherwise, right? So you get family members, especially children, adult children of the family, may have an outsized opportunity to take on responsibility and prove themselves within the family business that they may not have, right, in a generic business opportunity otherwise. So these kind of issues need to be thought through. And I would say if the family decides that it's time to start the process and that the business opportunity to sell is also present, then you can go ahead. One last point, and then I'll turn it back to you, is and I'll go into more detail later, I think, in this conversation, is the timing of the sale of a family business should start well before it's time to hire an investment banker and put it up for sale. The preparation to sell a family business, or any business for that matter, should begin years before the business is actually sold. And that's that. There are many best practices that are involved in that sale process, and we can go through many of those, Angelo, as you see fit. But what I would suggest is that unless the business needs to be sold fairly rapidly, that the best practices are that you prepare the business to be sold in a way to maximize the price. And that will take anywhere from 1 to 3 years. And so the decision to sell should come first. And then once that has been taken, then you take several steps that are key and important in creating additional value in maximizing the sale price of the business based on a body of best practices. So that's the timeline and the general thought process that I would suggest. Getting back to your question, emotional issues, that's hopefully I've touched on the key ones, but there are certainly a lot of complexities that are not generically addressed, unfortunately.
Of course. And I will have some questions that will still continue to drill down this road because I think they're important. There's a variety, having founded and exited some businesses, it gives me an alignment of purpose. It's fulfilling to me. And the opportunity of growing it, continuing the growth, maybe if you're a generational heir, and then the emotions of selling and exiting, what is again going to unify the family, although certainly some family businesses maybe do the opposite of unification, but usually if they're somewhat successful, potentially it's very unifying. Now, to me, being in the single family office community, depending on the scale of the exit, a single family office could take the place, because to me, that is like a family business of the capital and the legacy and the engagement of the rising generations. But let's see how we kind of play a little bit into that as we go along. Related to all of that, you have ego, legacy, and family politics that distort often deal decisions, including timing and a variety of other, again, emotional factors. Although now I'm bringing several new ones into play with ego, legacy, and intra-family politics. You're deeply experienced. How do you help to navigate this?
I usually defer to the trusted family advisors. Usually, not always, there will be a set of trusted advisors who can help guide through the, frankly, very individual issues that come about through a family sale. And Angela, you've seen this many times, and you've sold your own business yourself. But there's usually a lawyer, an accountant, a business advisor, board member, set of board members, or the entire board itself, often cases that know the family, know the individuals, know the opportunity to transition, as you mentioned, from a family business to a family office, and create legacy in different ways, right? So, and your point about legacy is often one of the most important points, and the known legacy issue versus the unknown legacy issue, the future family office, that's often difficult to weigh, as you know, because the uncertain, you have the known in the current legacy and you have the unknown in the future legacy. And so it's human nature to discount the future legacy if it's unknown largely. And I would say that the family office, and I'd love your thoughts on this, Angelo, but the opportunity for family legacy, in my opinion, is often greater with the family office, and the resources that come from selling the family business and transitioning into that family office, because the scope and the breadth and the depth can be much broader and deeper than just what the family family business was, right? So the scope and breadth and depth of that legacy can be subsequently much larger as well. But I don't know. I'm curious in your thoughts on that.
Oh, that's a very deep one, Paul. And you are correct. The family business is the family business. Our goal is to make money as a family enterprise within a narrow field, more than likely, of what our business is. The family office could mean multiple things to multiple people. Of course, making money, but not necessarily in a given vertical that the business was in per se, more diverse. We could argue about wealth preservation. I think a little bit overrated broadly as a bigger picture topic, but not a topic to today. But if I have a single family office, if I have a holdco, and if I integrate a private trust company and a family foundation, kind of the big four that I would likely recommend and intertwine, then that becomes far deeper. The private trust company provides the opportunity for the family and governance and joint decision-making, and the family foundation provides an opportunity, again, for unity of family, for giving back, sure, some strategic other purposes as well. But now you have multiple different entities intertwining on likely a far broader and in some ways more complex mission, so to speak, than the family office, which relates a little bit to and again, things I could relate to, especially the founder. If the founder is still living, how do you almost help them detach from the company they built for either the timing is perfect, the family opportunity dictates so, or challenges and conflict squabble leading to litigation? But that opportunity of detaching, and then where do you find that they find that sense of purpose, which is where I think the family office and the big other three that intertwine with it help to do that. as human beings, we need to strive for something. We need purpose. I would argue even successful. We need to feel like we're being chased by a lion. We're at our best when we're not necessarily playing golf every day and resting on our laurels. Mm-hmm. So now you're also a psychologist as well as a business exit strategist. And this is an interesting dilemma that perhaps I don't have the patience for, but I suppose you do.
I don't know. My wife is a therapist, a mental health therapist.
I didn't know that. I promise, audience.
So she can be helpful from time to time in giving me therapy tools. But your question, where to find purpose and that decision to detach. I mean, that goes back to what, my first set of comments, which is the decision to sell. And that sense of identity, right? It's identity, it's purpose, it's fear. I mean, the core, some very, very fundamental basic emotions are involved. Fear of the unknown, fear of letting go, fear of not being respected as if the founder is actively involved in the business, right? There's a lot of emotional satisfaction from people needing and wanting your direction, your leadership, your strategy. And then, that plays into the decision to sell, because it's like, if I'm the founder and I've had that as part of my life, that people are looking to me for leadership and they're looking to me for direction. And then I say, well, if I sell the family business, I'm not going to have that self-reinforcing identity of leadership. And then what? That's heavy, Angelo. You've seen it. That's heavy stuff. And
I know from personal experience, but also as you in the business for decades and seeing it. So I look at it as an opportunity first for purpose, aligned with intent, coupled with my sense of leadership, the capacity to inspire, and the ability to lead and the capacity for empathy as well, I think is important. And then that all segues into culture. And if I'm building a company or a family office and I don't have alignment in a sense of our intent and our culture, it becomes very difficult. Mm-hmm. You mentioned perhaps a little bit of my advice from my perspective. Do not, and this is going to get me hate, do not overrate just because someone has a good, we think, tax strategist, attorney, financial advisor, that they're in tune with the whole holistic picture of that person and family. They're often very linear in terms of their capability and their knowledge. And when it comes to the world of the single family office or after the exit, honestly, they're horrifically poor. And their opportunity to align a deeper sense of, like I said, of purpose to intent tends to be non-existent. They're very much more linear thinking in terms of their approach, for their technical capability, maybe is the word I'm looking for, and their ability to take in other disciples. And how many people really know that much about a single family office anyway? Very few. So I see the loneliness and the challenges of people with an exit, even with a lot of money. Again, golf gets old every day, day after day, week after week. So I could see that you're deeper than just a technologist relative to an exit. What do you think, Paul? What do you think is among a big mistake that I sometimes see is when they have the perspective of an exit, that they're looking to time the market for a sale. We all know in investing that timing the market is very, very hard. When it happens, we're probably more lucky than because of our innate ability. What do you think about timing an exit for the sale of a business?
So, one, I just wanted to back up just real quick. Your purpose, intent, inspiration, culture, couldn't agree more. And just wanted to reiterate, I think.
Well, thank you.
Your community, my plug is that for the family who's going through this angst of decision, your community provides a fantastic way of talking with other families who have gone through that process. And I think that sense of community, like you said, there may be an advisor to the family, lawyer, accountant, advisor, board member, who can see many of these issues. There may not be, but I think I would encourage people to dive deep into your community, into people who have been through that process before, to understand the issues, the emotional and process questions that come from this very unique and individual decision, heavy emotional decision, because your community is perfect. You've got, dozens of families who are either going through the same thing or have already gone through the same thing. And I think that's the value of what you're building. And I just make a plug for, going deep into your community. But then the other thing I would say is, in my opinion, from what I've seen, the family office can be very inspiring, because you've got different family members with the different roles you talked about. You could have, the private trust and the holdco and the foundation, and different family members can go and specialize in these different areas and find really deep meaning that they may not have been able to find in the family business, right? But now all of a sudden they're driving a foundation, they're co-leading a foundation that could be extremely meaningful, where the family business may not have given them that opportunity. So I think, in my opinion, I would say go deep within your community and get inspired about what the family office can do for legacy and sense of purpose and inspiration and identity that is not going to be left behind. In my opinion, it could be magnified going forward. So just wanted to cap that off. So your question was in terms of the timing, the timing of the exit and trying to time the market. I'm a Warren Buffett, fan, and he's always preaching against trying to time the market, because, only 0.1 or 0.2% of the people actually are able to time the market successfully, and that's by luck. So this goes back to what I was mentioning earlier. I think preparation trumps luck every single day and on Sunday. I mean, the amount of as you prepare your business for a sale, that's in your control. And there are many best practices that you can implement that can create significant value that are within your control. Timing the market is almost impossible. And the problem that makes it even more difficult is that you have to be adequately prepared and on point to sell in order to time the market. And timing the market and being on point and having prepared adequately for a year, 2, 3, you add all of those together, and it's like, it's almost impossible. It's a low probability times a low probability times a low probability. So I would rule that out and say, let's do what we can within our control. Let's prepare and use best practices to prepare instead of timing the market. Now, look, if we're in the middle of a severe recession, obviously and you're about to sell, and then the country goes into a severe recession, obviously you'd put it on hold for a little while, right? Without a doubt. But generally speaking, preparation will trump timing. So that's my thoughts.
And Paul, staying along your lines of best practices, what are some best practices for aligning, like you said, the stakeholders, the family, the board, management, pre-exit? What would you recommend? You mentioned you want to get that potentially planned well ahead of time, possibly years. What are some tactics that you use?
In my opinion, nothing is better than communication, and frankly, feeling maybe a little bit vulnerable and expressing some vulnerability in the communication, in aligning the values and aligning the decision-making process. So I think there's two parts to that. It's the aligning perspective and values of why we would want to sell to begin with, and then aligning perspective and values of what can we do afterwards. And, like we said, there's the decision to sell is highly emotional, but I think best practices in terms of alignment is over communication, right? Over communication in terms of what the ultimate decision makers want to do, why they're doing it, the fact that this is not easy. It's been a long-term decision to get here. It's been a long-term thought process to make, build buy-in as much as possible. Influencers may not have the second generation or the third generation may not have a direct stake in the decision, but they're still stakeholders. And they, again, as influencers, as stakeholders, their involvement will be key in terms of building buy-in. That would be less likely to create ripples and problems and, frankly, political problems or lack of a buy-in problem later. So I would say over-communicate on the decision, even if they're not direct decision makers, to try and get consensus and alignment, but also over-communicate on the perspective, meaning, and what that means. And that's where influencers or stakeholders can have a bigger role, is the future. And so get them, if they're not necessarily on board with the decision to sell, it may be easier by giving them the vision of what that means after the sale, not only for the family, but them directly, in saying, now in a family office, there are many roles that may not have existed before. So giving them excitement, sense of purpose, identity, involvement in the future aspect of the family office might help in the alignment of the sale process.
And how do you negotiate premium multiples without appearing desperate to exit as a business owner?
That's the number one question everybody always asks. How do I get the best price without easily and without appearing desperate? So preparation is key, and we can go into details in terms of what that means, but preparation is probably the biggest aspect. The next is very good advisors. A very good investment banker and a very good law firm will be absolutely key in helping you get a premium valuation. I've bought business, so my background, as you know, Angela, but maybe others don't, is I worked in corporate M&A and corporate venture capital for most of my career, and I've bought a bunch of businesses from families, and I can tell you consistently that the families that had top tier representation got more money out of us than those that did not and that weren't prepared. I have direct personal experience in what I'm saying, that we paid significantly more for those that were prepared and had top representation, legal and investment banking, and those that don't, frankly, suffer in terms of terms and valuation, both. So get prepared, hire the right advisors, do the work to get it ready. And then, unless it's a fiasco in terms of an economy, you've done everything you can that's within your control, and then you take the right steps.
I mean, there's so many questions from there, Paul, and again, we could make this a multi-hour discussion, but you mentioned two right there that I remember an old sage as a buyer of family businesses told me, as kind of as I was creating my holdco and looking at being more active, like, Angelo, I often tell the owner, assuming the numbers are legit, that you could have price or you could have terms. I'm not going to give you everything you want in both.
Mm-hmm.
I think I can make the argument, unless the price is ridiculous, that controlling the terms might even be more important.
So that's a fascinating conversation. I know a good friend of mine runs his own family office, and he actually runs a multifamily office business. And he has told me many times, I don't care as much about the price if I can control all of the terms.
Exactly.
So now people will disagree with him, right? Some people will disagree with him, and reasonably so. Intelligent people can disagree on this point, and they do. But the terms are critical. You're right. I mean, people need to have the right expectations, as you said, and it sounds like your advisor was trying to manage your expectations. I can't give you the world, right? I can't give you everything that you want, and that's critical for people to understand. I've negotiated almost 100 transactions, both buy and sell, from the corporate perspective as well as venture capital. Me personally, Angelo, I'm not quite in the same place as my friend that I just mentioned, but I'm a little bit more balanced. I try and get the best price possible on reasonable terms. That's my general approach. I'm willing to sacrifice some reasonable terms and in order to maximize the price. And my rationale, which again some people will disagree with, is cash in the bank is cash in the bank, and then terms are built around contingencies and probabilities and risk protection and the reasonable ability to protect the cash in the bank that I just put in the bank, right? And so I'm taking the approach of let's maximize the price on reasonable terms, and the terms represent contingencies and probabilities that in many cases won't come to pass to affect my value. And so I'm willing to take that risk because the expected value of those contingencies and probabilities are lower than the 100% chance that I have of cash in the bank. That's my approach, but again, people will disagree.
I mean, we could get so deep, Paul, into this subject, from really almost a masterclass on buying and selling businesses and the perspectives from each side. I look at it broadly as look at the number of baby boomers that own businesses that are aging out. A lot of them that are doing well, especially if they're more blue collar type businesses. A lot of the children were so-called better educated, don't want to, for lack of a better word, get their hands dirty and roll up their sleeves. They don't have as much interest in these businesses. I don't know what it is, AI, social media, but these are intriguing businesses that ironically are probably relatively safe from LA. I don't know if anything is safe from LA, from AI
or DC,
from AI and robotics for years. Septic type businesses, fencing, construction. Now, I know private equity is starting to get into a little bit more of the larger scale of that, but I would say there's a lot of opportunities out there, I think, for buyers to potentially control the terms, as we briefly spoke about earlier. We may be getting a little off topic here, but how would you recommend that the new blood that may have some capital, that wants to put it to work, that wants to invest in private companies for a sense of control, for family engagement, what are some sources that you recommend in any varying sectors that they get out there and they see what's available? Are there databases? Are there AI enhanced databases, trade shows, investment bankers, business brokers? What are some insider secrets that you have?
Yep. So I'll tell you a little bit of history that helps guide kind of the best thinking right now, is that family offices probably 5, 6, 7 years ago became much more heavily involved in direct private investments. And they said, we've got a family office, we've got a bunch of resources, we can hire consultants, et cetera. Why pay the fees, right? The fee, and primarily they were trying to avoid private equity fees and venture capital fees, and said, why pay the fees? Let's just use our resources and do this on our own. that didn't end well for most family offices because the lack of specific sector expertise, the lack of deal-making experience, the lack of familiarity with the terms, as we were just talking about. It is a very deep well of experience that most fund managers have already acquired. And so there were many family offices that felt a little burned, felt like they'd made some bad decisions. And now the pendulum has swung a little bit more towards saying, let's pay the fees, but learn as we go from our fund managers who, generally speaking, are more talented, more experienced in these specific sectors than we are, unless it's the same sector as the family office, right? Where there may be some very deep family experience there. So what I've seen is, family offices are saying, let's invest in funds and get our feet wet, get some experience, work in some cases directly with the investors, the fund investors, to understand these sectors better, and then get involved in direct investments through the fund. So SPVs, co-invests. That's a great way for family offices to leverage the expertise and the due diligence of very talented fund managers when they come to them and say, here's a one-off deal. You can invest in the fund or you can invest in SPVs or both, but we're bringing you a deal that we've diligenced, that we're going to invest in the fund, or we have invested in the fund, so we're eating our own cooking. And now we're giving you the opportunity to evaluate this on a case-by-case basis and get involved and learn that way. And so especially for a newer family office, my recommendation is get your feet wet by learning from people who are already heavily investing in certain sectors, whether it's AI, energy, climate, real estate, what have you. Learn with and alongside those managers, especially through SPVs and co-invests. And then with a body of experience and a decade or more of experience and good results, then family offices start, justifiably so, start investing, and these investments often pan out very well. But if they jump in and think, I can do it all myself without that proper level foundation of experience, that's where we were about 5 years ago, and it didn't end well for many. Some fine, but not many family offices.
Now we got a real interview here, Paul, because we may take a little bit of some opposing sides, and that's how my audience, I would like to hope, best learns. By the way, broadly what you said, I don't have a massive amount of disagreement with, but because I like to be contrarian and I like to think that family offices strive and can be awesome, maybe there is a way they could skip the line a little bit. So I have concerns that the so-called professionals could be bureaucratic and often not that good. If they're too large, they become effectively asset gathering machines that are looking to collect 2 and 20, and they become almost too big, too bureaucratic, especially in certain sectors in venture capital and private equity, to even move the needle net of fees. And if you look at some of their return profiles, those that even want to share in more public databases, what their return profiles are, net of fees and the limitations of it, not always quote unquote so attractive. The advantage that I'm going to have as a family is potentially the capability of moving quicker. That's one. I'm going to have patient capital. I'm not looking to have a strategic exit or this or that in 3 years or 5 years. Maybe I want to own it for decades. There are some other advantages that maybe you're leaving out, where if I'm a family that desires control, I want to have control. I want to have the controlling interest, however that's defined to the business. I want my family to learn, meaning my rising generations, how the real world works, how you negotiate, how business owners lie to you, how you need to not only not really trust, but verify, how you negotiate with banks, how you do financing. There's lots of life lessons in that. And you're correct. Am I going to have the expertise in those verticals? More likely not, but could I structure, and I don't want to get too deep on holdcos here, but I could bring in the right operator and incentively align them that we're in it together for the growth of what we're building. I may underpay you a little bit from an annual quote unquote compensation, but you're going to be treated, maybe it's phantom equity, but you're going to be treated like an equity holder. And we're going to look at various exit opportunities for you that may be 3 or 5 years down the road. So could I make that point that I was a little long-winded, as I usually am, that there are grains of truth, if not more, to my perspective of jumping in at the advantageous opportunities for a family if they're doing some of the things I'm noting correctly?
Yeah, this is so interesting. We did not coordinate our comments just for the audience here, Angela, but I literally made a LinkedIn post on this, I think 7 to 10 days ago, on the precise topic that you mentioned of large funds becoming asset gatherers, and frankly, the blatant conflict of interest that exists when you're making anywhere between $50 to $200 million a year from your 2% fee. What incentive do you have to rock the boat and get the best tier returns for your investors? They're locked into a 10-year fund where the fund manager's making $50 to $200 million, right? Like, don't rock the boat. The statistics show that first and second funds consistently outperform large funds, and I think it's because of the conflict of interest issue that you mentioned and that I just mentioned. My LinkedIn post, end of May, like the third week of May, depending on when you're watching the recording here, third week of May of 2025, talks about the statistics that show that first and second funds get the top performing numbers and performance of the year 73% of the time. So 73% of the best performers are Fund 1 and Fund 2, maybe Fund 3, but I don't think so. I think it's Fund 1 and Fund 2. Those funds get the top slot 73% of the time over a 10-year study.
Well, in some ways, that's concerning. Where's the value and experience?
Well, so you have funds that, so I mean, just a shameless plug, Exit Ventures, my fund, right? I've got 30 years worth of investing experience. I've run a hedge fund before, but this is my first venture capital fund, right? So some people would say, well, you've got fund experience, you've invested $3 billion, you've got the experience to run a fund, and others like, nope, you're a Fund 1. I can't really trust you with the experience that you need in order to run a fund, right? So some people will say that Fund 1s are risky because you don't have any track record. If the fund managers have a very solid track record, but they just happen to be putting together the first fund, then that seems like a reasonable bet to me. I mean, that's the bet I'm making, and I'm asking other people to make. But the statistics actually show from multiple independent sources that first and second funds outperform the big funds precisely because of the issue that you mentioned. And I think it's because you have, in a smaller fund, you have the hunger, you have the alignment of interests, you have the grit, you have the hours, that are required to launch a Fund 1 or Fund 2 that, frankly, when you're making $200 million a year, you don't really worry about as a large fund. So my personal, and again, I am speaking my own book here, so I'll raise my hand and say that, but the statistics show that from a fund management perspective, smaller funds tend to outperform the larger funds. I think it's due to the conflict of interest. Because others are contrary, Angelo, some people would say the larger funds, because they're so big and have such immense resources, that they can anoint market leaders in any particular industry by saying, we're going to anoint this one company the leader, we're going to put in $50 to $100 million, and they're going to obliterate everybody else with our capital. Some people believe that, and so they invest in the very large funds, but the numbers don't support that belief. So whatever you want to believe, there are people on both sides. intelligent people will disagree on this point, but I say I'm a data-driven person. Let's look at the numbers, and smaller funds typically outperform. We can have a conversation on this, Angelo, all day long. But what I'm saying is I agree with you. And your last point, just really briefly, you said hire somebody. Let's get someone with experience and invest together with aligned interests. I mean, you're basically replicating a pseudo fund, right? And that's a reasonable position to take.
With a big difference that I have patient capital and I don't want to turn my kitchen into a restaurant and take in others and get additional regulatory scrutiny as well. Now, yes, I would offset the cost of the internal talent by doing that. I may be able to have more capital to put to work. You have to weigh this as a family. My experience, most real single family offices, they're better off probably staying that way and not looking to get too cute, becoming more of a commercial enterprise where there's way more competition, way more scrutiny. And I think just looking at what I've seen, it's just harder. And I know it's something that I don't have an interest in, but that's just me.
Yeah, look, I mean, intelligent people have really strong opinions on all of this. I think you're right. Like you can make an argument to say that let's stay clear of other investor entanglements. Let's hire someone. And if you've got that person or those people that can replicate, pretty much all of the experience factors that you need, the investment side, the industry side, the investment terms, the board seat, and the exit creation, right? If you can effectively replicate all of the resources that you would typically get in a fund, and you can do it on a cost-effective basis that's entirely driven by the family office, it's not a bad gig. I mean, it's not. But that requires probably multiple people who are really talented, where you've got to make the right hires. If you can do that, I mean, more power to you. You've basically created your own fund, and that's powerful.
I mean, kind of. If I have a family office that has a CFO and a COO, part of their responsibilities may be to also onboard, enhance, and improve, and do those services for companies that I may be bringing into my holding company, perhaps as an anchor, offsetting losses. And again, we could get a little complex on some of the tax picture here. I don't want to bog things down. Then bringing in the right operator in that given vertical. And like I said, giving them the opportunity, even if it's phantom, but effectively it's kind of the same thing. Well, maybe not as much from the tax perspective. But again, I don't want to get too bogged down in it. But there are various ways to skin the cat. Paul, I will have to ask, I got about 7 or 8 questions that we may go a little more rapid fire on from the topic now, but I do want to save, even if it's just 2 or 3 questions, for the others. So we're going to move it along, but I'm probably going to need more than the hour that we booked. But I'll do the best I could. Why don't we go a little more round robin?
I'll be brief, more brief.
Okay. A little bit of a unique question. When do you not sell? What are signs from your perspective that a family, well, they might not actually be ready?
I would say a couple of things. Lack of internal alignment. There's broad disagreement. And you have no clear decision maker. That's tough. That would be a tough position where you may create more discord than anything by selling. Or on the opposite end of the spectrum, the business is killing it, right? Your family business is killing it, and reasonable people can say that it's not just current emotion, but the forecast and the outlook looks very strong given the position that the family business has created. Someone would say that's a great time to sell because you're going to get a premium valuation, but other people would say that's a great time to hold because you've done the work to kind of kill it for the next 5 to 10 years. That's not a bad decision to just hold as well. So I would say those 2 things are the first that come to mind.
Okay. And keeping things going, how do you structure things like earnouts, rollover equity, contingencies to preserve some quote unquote long-term upside, if that's the word I'm looking for?
Earnouts are difficult. Earnouts are fraught with a lot of disagreements, lawsuits. I caution people against earnouts unless it's just really the only way to get a deal done, and you want to get the deal done, knowing that there is risk with an earnout. I'm assuming from the seller's perspective, right? From the family office, from the family's perspective in selling their business. You need really good advisors. Structuring them just very quickly. This is a very complex discussion. It's hard to say something in 30 seconds, but just very, very briefly, make sure that the targets, the performance targets and the KPIs are very well defined, very clearly defined, and clearly something that the business and the family feel strongly that they can achieve. The other thing is that they need the power and authority to achieve them. So you can't give up power and authority on one hand and then say, I've got to achieve all these KPIs on the other hand, when the new business owner doesn't give you the power and authority to achieve your earnout. So this is why it's so fraught with disagreement. Is the owner's going to say, I own the business. But if there's an earnout, you have to tell the owner, you own the business, but you have to give me an umbrella to shield me from you and conflicts of interest, where I need the power and authority to actually achieve my KPIs to earn my earnout. That's a really long conversation, but those are the 2 points that you got to understand really well.
I mean, more so from the buyer's side, we'll have to leave this one by the wayside, but understanding maybe from an investor or family office buying and controlling private companies, why would I do that unless I feel like I have certain an edge, so to speak? And how good am I at implementing technology to enhance operations? And you reminded me when you said the word KPI, because I'm a massive devotee of Jim Collins, Peter Drucker, and I think about setting goals. I think about objectives and key results. I think about key performance indicators. And shockingly, now many of the type of business owners in certain businesses I described that are a little more loosey-goosey, maybe more blue-collar centric businesses, there's lots of room for operational management enhancements and technology improvements that could make effectiveness and efficiencies in the business much better. But sadly, we're going to put that one on the hopper or on the sideline and talk about it at a future time. I got an interesting one for you. How do you protect founders from getting steamrolled, Paul, in private equity backed type negotiations?
Oh, yeah, you've hit a hot button of mine. So I know several people who have worked their entire career to sell their family business, and it's usually not a large, sophisticated family business, but business of 5, 10, 15 million in revenue. They've worked their whole lives. They decide to sell. They sell to private equity. They didn't take the step of hiring the right, sophisticated, deal savvy advisors, and they got steamrolled. And several never got more than half of kind of what they expected because of either the terms were horrible, the private equity fund got into trouble, the way they structured the deal, they could back out of obligations through bankruptcy and blah, blah, blah. Anyway, there is, I don't want to paint a, stereotypical brush, but I will anyway. There's a lot of, I'll say it, malfeasance in the way that private equity structures a deal to buy family businesses when you don't have sophisticated deal counsel, not the family lawyer. You cannot use the family lawyer and say, I have a sophisticated lawyer representing my interests. It has to be a transaction lawyer, an M&A lawyer, and an investment banker. They know the pitfalls. They know what to avoid. They know when you're getting, terms that you're going to get taken advantage of. It happens all the time. I hate to be stereotypical, Angelo, but it happens all the time. And It's unfortunate that the industry suffers from a lack of credibility, but it's for a reason. And so I would just say advisors, you got to hire the right people.
And a somewhat of a related question, how do you compare the long-term outcomes of selling to a strategic buyer versus a private equity firm?
So generally speaking, a strategic buyer will pay more than private equity. This is why people like to sell to a strategic, is because unless you can get an IPO at really hot part of the market in terms of the IPO market,
right,
a strategic sale is usually playing the odds, the most attractive risk-adjusted outcome. About 80%, 85% of exits are to strategics, and about 10 to 15% of exits are to through the IPO market. And so you're going to, generally speaking, you're going to get a much better deal to a corporate buyer than private equity. Private equity is a very financially driven, I want to get an extremely good return from my acquisition. And strategics are looking more at the synergies, and they have synergies, which means, 1 + 1 = 5. And so there's more of a pie. There's a bigger pie to share when you sell your business to a strategic that can create synergies with your business. And therefore they're willing to pay more in some cases than private equity, where there's not as generally, there can be some nice synergies with private equity, but they will never share any of them unless they're forced to through an auction. And so that selling to a strategic will almost always result in a better outcome due to the synergies, the bigger pie, and frankly, a little bit less of a shark approach.
Are there specific signals, indicators that a business is better positioned for a premium strategic sale versus more of a, let's call it a financial buyer exit?
One of the best and easiest ways is the fact that the strategics are coming and calling. Right?
Of course.
It's a no-brainer. Like, if you've built a good, solid business in your industry, and it's above the 10, 15 million in revenue, some 50, 100, multi-$100 million in revenues, you will have people coming and calling, right? There will be a ton of private equity, and there always is, because there's more of them. But when strategics come calling, there's your sign, right? I love that saying, there's your sign. A little blue collar comedy tour for anybody who recognizes that. But that's just because we don't have a lot of time, Angelo, that's the best way to start to realize if you've got multiple strategics coming to you, then you've got something that could potentially be sold to them for a nice premium.
Paul, I think it's time, although I think we could spend hours on this, and I would love to. We'll definitely do a part 2 later in the year. But I did promise a little bit of a varying 1-2 punch, because I called you, what an incredible polymath, that we could basically kind of switch directions. Now, you could also argue in buying and selling, the kind of infrastructure and businesses we're talking about, they're intertwined, but we're treating them somewhat, quote unquote, separately. So this will be shorter than what we covered from strategic exits, private equity, and basically preparing a family business for sale. And that is going to be a little bit of the infrastructure, energy, the grid. And why don't we get started with what's the real state of America, meaning USA, our power grid, and why is no one talking, from my perspective, enough about it?
Okay, good. Great question. So the core issue is that with the growth of AI and the electrify everything movement, not just EVs, but how do we electrify core industries, heavy industries in some cases, steel, concrete, everything, cement, everything. How do we electrify everything? That's putting tremendous load strain on the grid. Energy utilities, electric utilities, are used to having demand grow 1, 2, maybe 3% a year for decades. So you can imagine, Angela, if you've got a very slow moving, very stable industry with the electric utilities, and then you add AI and electrify everything, all of a sudden they're looking at demand forecasts of 7, 8, 9%, which
Yes.
doesn't sound like a lot to a family business that's been growing 5 to 10% a year. But for utilities that have to
It's
invest in
massive.
hundreds of millions of dollars or billions of dollars to generate new power facilities in a sleepy industry that is not used to moving quickly at all, this is creating a crisis environment where many utilities are now caught flat-footed. They don't have the generation capacity to keep up, and they're going out on the spot market and they're buying electricity on the spot market to cover them when they don't have enough, and they're paying 10 to 100 times more than their cost to generate power, because now they're forced to buy it on spot, and now everybody's buying on spot. So you have a situation where the supply is limited. It can't grow very quickly because it takes years to build a new power facility. And then you've got demand growing much faster. And so you've got this gap between supply and demand. And the biggest impact that AI will have, other than, how easily it makes us, do the hard things, is the demand on the grid. And so people are talking about, what do we do? And the hyperscalers, the Amazon, the Microsoft, Googles of the world, are snapping up power generation facilities as fast as they can, or they're signing up contracts for that available power as fast as they can. But there's not enough generation supply to meet the demand. And that's why you've got 3 Mile Island, a nuclear, 3 Mile Island nuclear facility that has been idled, that is now being brought back to life by Microsoft. You've got intense interest in any kind of power, whether it's renewable or not, because AI just needs power and we're not going to have enough. And so what I'm worried about, the short answer is, in 3 to 4 years, the forecasts look pretty ugly. That AI continues its very strong growth, electrify everything continues its very strong growth. We've outstripped the whatever small amount of capacity exists in the country's system. We've soaked that up, and we're not able to put stuff generation online fast enough. And there are some scenarios where we're talking about brownouts in 3, 4, 5 years because we cannot put generation assets online fast enough. And that's the macro perspective we're looking at.
Wow. Well, that brings up a lot of questions. Where do you see, where are these biggest choke points? You mentioned generation, probably number one, but as you know, in my little bit of knowledge, I could also say cooling, storage, transmission.
Mm-hmm.
Now, we could put on our investment hat here and say, what public and private companies, knowing what you said is the big picture macro, knowing the choke points and challenges that I noted, therein lies potentially the opportunity. So
Mm-hmm.
I'll allow you to go in multiple different directions, from clarifying generation, cooling, storage, and transmission, to looking at it from the little bit of the investing perspective, what opportunities are now out there.
Yep. There are so many opportunities out there because of the need. So you're right. It's not just generation. Generation is kind of the root cause, but you have transmission lines where they're 40, 50 years old. They're at the end of their life. In many cases across the country, they're not built for this. And it takes many years to build new transmission lines. It just does in the United States because of regulatory and lawsuits. It's very difficult. Storage. Now, the good news is probably I would say half or more of the solar panel facilities, large scale solar facilities that are implemented now, are being implemented with some sort of battery storage system, which helps our ability to serve the peak hours on the grid. But that's a drop in the bucket compared to what is needed across the country. So you have opportunities in generation, transmission, storage,
Exactly.
and also what's called peak shaving, which is how do we bring down the demand curve during peak hours, and how do we flatten that curve so that the utilities don't have to go out and buy so much power on the spot market, almost on a daily basis in some cases. So there's a very wide range of opportunities. Large corporations are digging in very quickly. So GE Vernova right? They make the natural gas turbines that everyone needs to provide large amounts of electricity. They've now got, I think they've got a 2 to 3 year backlog for, and in some cases, maybe more for their gas turbines. So people are saying, well, I need to go buy a turbine and build a facility. Well, guess what? You can't even buy one for the next 2 to 3 years in many cases, not always, but in many cases. Putting in new lines, well, putting in new transmission lines can take 5 to 7 years to get them approved, designed, permitted, approved, and then get through litigation because no one wants.
If you don't mind, Paul, now I'm going to be the Mr. Libertarian conservative prick. I hear what you're saying. I know it's true. My audience knows I'm extremely active in the world of AI, and I'm active in geopolitical issues. This is a war, cold for the moment, between the US and China. We lose the AI war. We lose the advent of AGI and artificial super intelligence because we can't manufacture comparative to the no guardrails of China and the energy production. We get whipped from them being able to manufacture things at practically no cost. We would be priced out of the market. God knows what's going to happen with other forms of alternative energy that could, in the future, bring energy costs way down, and we're not going to be a leader in it. Defense-wise, biotech, we fall so far behind, there may never be a chance to recover. And you're telling me, even in the current administration, that we're bogged down by political bifurcation, regulation, and lawsuits. We won't win. Like, if something doesn't happen, I don't know how Elon was able to build, what was it in Tennessee, that massive data centers so quickly. And that technically was under the Biden administration. If we don't have certain things that change, we will lose to China. And I know we're getting into my bandwidth of geopolitical now, but nonetheless, I'm bringing you into it.
I agree with you. Look, the issue is we have an advantage. We've had an advantage in AI. The advantage is getting chipped away, but we do have a leading advantage in AI right now. The problem, as you stated, is if we don't have the hardware to support the AI generation, right? You need hardware and software. And I keep telling people this, like, we have a lead in AI, but if you can't build the data centers in order to keep that lead, China will then take the lead because they are able to outcompute. They have the raw compute that we don't. And once you get that lead, it's very difficult to let us catch up, right? And especially with quantum computing, when we've got AI and quantum computing that need real hardware resources, and we are in a position where we may not be able to build the backbone to support a leading AI and quantum computing edge, we are in a very real jam where we may lose, not because of the quality of AI, but because of the quality of the hardware backbone. And that's a bitter pill to swallow, frankly, but it's something that we're looking down the barrel of, something that's not very appetizing right now.
Everything that you think about, if and they're definitely ahead in quantum, they get certain edges to crack codes and banks, financial institutions, Bitcoin, etc. Like it might be kind of over. No, maybe not overly literally, but in terms of us being the domineering world power, we would definitely take a secondary role. We would have massive upheaval to our financial systems. You could then imagine the civil upheaval that we'll have in the country. Imagine banks being closed down, shut down, ATMs not working. You have whatever 700,000 in your 401k. You go there and technically it was liquidated. I'm not saying you may not be able to do a trail and get that back, but imagine that happening a million times over and over. It's going to overwhelm the system. I know some of you feel, I wish I could slow the march of AI down. I wish we could have guardrails. And trust me, in my heart, like, I do really kind of hear you, but that's just not realistic to how the world works and the competition that we're having at the moment. We do that, they won't, we lose, and calamity happens. I don't know if there's any easy way out of this, Paul. Maybe and maybe we'll pull it back to the investing side a little bit now. What could I do as an allocator? What are we looking at here in the US, maybe Canada, broadly North America? How could we be competitive? What could I do? And how could I profit? Is it oil? Is it alternative energy? Is it clean tech? Is it solar? At least I get certain tax advantages. What could I do as an allocator?
Yep, no, that's great. So what we can do is we can pressure policymakers to wake up. Some have woken up, and some are extremely concerned about this issue. Some, I think, are more engaged in petty politics than they are the real long-term strategic position of our country. And I genuinely believe that conflicts of interest in our electoral system are creating real long-term and midterm problems for us. The good news is that, Trump, whether you're a fan or not, and I'm not saying I am or I'm not, but he, last week or 10 days ago, signed an executive order trying to accelerate the pace of nuclear innovation and deployment through executive order. That should be very helpful in deploying nuclear power assets more quickly than they would otherwise be deployed. And after that executive order, I've heard just secondhand that over $100 million has been raised just in nuclear because of, and as a direct result of that executive order that makes it more easy to invest in, test, prove nuclear electricity assets. And so that will help. It's probably not going to help in the market in terms of power generation for the next 5 years or maybe more, but it will help at some point. What can you do as an allocator? You can invest in, frankly, look, I see it every day. I'll say it again. I'm singing from my own book, but private equity and venture capital and other investors are raising money for energy assets. And we need hard physical assets, frankly, more than we need a next version of AI that helps generate a pretty picture. Literally, like I'm a little frustrated about how many people are so interested in non-core applications of AI and investing money that could go to extremely urgent needs. The extremely urgent needs are the infrastructure and continued development of key strategic AI. Making a funny picture and gaming based on AI is not where we need to put our money. I mean, honestly, like just get so frustrated. We're looking at a crisis here, and a lot of investors that I know are investing in gaming and, AI photo and video editing. And I'm like, that's not going to help anybody in 5 years. So think strategically as an allocator. I mean, look, we are raising money for the peak we're about to invest in a peak shaving technology that's very interesting. The one company alone has the potential to save literally terawatts of power across the entire country. When you start talking about terawatts of power, that's what we need. We're about to invest in this company in a couple of weeks. Like the bigger our fund was, the more, frankly, we could invest. That gets this company on a better footing. Like that is critical action that you can take as an allocator, is ask investment managers, what are you going to do with the money? Are you investing in absolutely core strategic needs? Or are you investing in what I call frivolous stuff that frankly isn't going to help the strategic direction of this country?
Very good points. And I can't help but comment on one thing you said from the political angle of politicians and reaching out, making your voice heard, voting. The politicians that I know, and some of them were family office principals, and this is a little bit of a sad commentary, but it's the reality of how things are. Their number one goal is to get elected.
Exactly.
Now, guess what? Their number 2, 3, 4, or 5, basically 2 through 10,000 reelected. And that brings up the whole issue of the short cycle of the midterms coming up in about a year and a half. They just care about reelection. The whole thing about AI potentially which is not untrue, but the advent of how things are playing out, taking jobs and all that, is not going to play well in terms of in the election. Even Doge and the cuts and people being let go. Then they start to hear pushback internally in the Republican Party. And all of a sudden, as opposed to dealing with our debt, which is massive at 37 trillion, we now have a big, beautiful bill that looks like it's going to be adding to, quote unquote, our debt and the challenges that we have. The hope and thought that I had going in of the reality of how Doge and trimming the debt, things that Dalio talks about, could play out, just honestly hasn't really proven true. Now, again, I don't want to make it a overly political discussion. My audience does know that I wear some of my libertarian politics on my sleeve. I definitely was not a fan of the alternative, but I'm a little disappointed in how certain things from the perspective that I'm noted have played out. The executive orders that you noted, or the one specifically, we'll also see if that sticks, depending on the courts, the judges. There's so many different factors there that play in. Maybe my last question, and then we'll hear from you about how families can learn more about some of these opportunities that you're describing. What is and maybe you already mentioned this actually, but the one infrastructure bet that a successful investor family could make now, but they probably aren't. They're overlooking at it. Now, you noted they're putting it broadly into AI and gaming, and they should be putting it into more infrastructure. If you could give a little bit more detail.
Sure. Yeah. So you've got large corporate interests that are playing in certain areas, right, where a family office investor may or may not be able to play. Generation is a very big ticket item. Utilities and now the hyperscalers and very, very large investors are getting into that game. The family office probably isn't going to, get into building a 500 megawatt, power facility, right? That's off the table. But family offices that I know are investing in nuclear, whether it's fission or fusion technologies that theoretically could come to the market, within 5, in my opinion, up to 15 years. I think, just my opinion, fusion is a longer term bet. SMRs or small modular reactors are a more near term bet in terms of nuclear if you want to do power generation. That's something that you can look at, and a bunch of family offices that I know are actively looking at or investing in SMR nuclear technology in order to try and bring that to the market sooner. You can look at different types of emerging technologies. There's lots of emerging technologies across the board in generation, transmission, storage. One of the biggest opportunities, in my opinion, is storage. For the average investor, because storage is not being dominated by large corporate interests other than lithium in China, but there will be challenges to lithium. I'm confident of that, given its limitations, and there will be other market segments where lithium can't really serve. I think storage, power storage, can be very interesting. Transmission technologies may or may not be, frankly, because that's dominated by very large corporate interests. I think a lot of the AI tools, software tools for power generation, for power storage and transmission, lots of room there. And so I would say, both venture and private equity are putting a lot of money into this. Ask your managers where they're putting their money, and if it seems like a good fit to you, or look at SPVs, like I said, SPVs and co-invests. You could invest directly into very specific projects, knowing exactly what your money is going into on this stage. And we're doing that, and many other managers are doing that. And I think that's frankly not a bad solution.
Indeed. And Paul beat me to the punch a couple of minutes ago. I was going to bring up nuclear in relatively a quick format, and he answered it. And the advent eventually of fusion energy, which could solve a lot of problems, but likely isn't going to happen tomorrow. Probably not 100 years from now either. So is that timeline 5 years, 10 years, 20 years? I don't know, but it's coming. And again, China definitely has an edge, we believe, on that as well. And the fact that they may make me and other people a little paranoid is not necessarily a bad thing. Just like when DeepSeek was announced, was it January 28th, doing more with less, and it rocked NVIDIA and Silicon Valley, it woke them up. That China does have some advantages and edges and is being very creative with less powerful chips. We got to wake up. It might have been a bit of a wake-up call. So not necessarily a bad thing in the long run, but let's see what we do with it, both as the American people, as talking as an American now. I know I got a global audience, although I wish it was bigger, and our politicians. Let's see if they're going to do the right thing. Paul, this was great. Kind of mastering high stakes exits and a little bit of a passionate wrap up on kind of the energy and infrastructure kind of behind AI. Our special guest today, Paul, and Paul's last name, B as in boy, Urgon, managing partner of Exit Ventures. And Paul, for those that would like to learn more and even allocate to some of the things that you're talking about, and do understand, audience, that would need to be likely at minimal a accredited investor. When you invest, what could happen? You could lose money. You need to think for yourself. You need to do your own diligence, and you need to make your own decisions. And even among Paul and I, you may hear this 6 months from now, and the macro factors and a lot of other conditions could change that could cause us to change our opinion. Where at least me as an investor, I'm imperfect. I like to throw my thoughts out there from an engaging and somewhat entertaining perspective, but you need to think for yourself, do your own diligence, and make your own decisions. On that wonderful, cheery note, Paul, how could people learn more?
Yes, I agree with you. Look, sophisticated people need to do sophisticated diligence and make their own decisions. And fortunately, accredited investors usually have the ability to do that, and highly encourage you to do your homework. If they want to reach out to me, I'm happy to talk. I'm very passionate about this subject, as you may have noticed. If you want to reach out and offer to help or ask questions, get involved. My email is paul@exitventures, plural, ventures.net. You can go to our website, exitventures.net. And would be happy to reach out to you with your, in response to your questions. If you just have, tips, suggestions for various technologies or companies that that may be interesting to us, we would love that. Always interested in investors or just people who want to help, or frankly, maybe commiserate a little bit as well. That's totally acceptable. And really appreciate the conversation, Angela. I feel like we could do this all day long and then again tomorrow, and I think that would be a blast. So hopefully we can have another opportunity.
Of course. And now, again, my members specifically could always reach out to me. I'm happy to make a more favorable introduction. But Paul, for those that would like to learn a little more from afar, whether it's following you on LinkedIn, whether it's a website where they could inquire or learn more and follow you in any format, X, how could they do so?
Yes, I am on LinkedIn. I post semi-regularly on LinkedIn, and you'll see a long history of what motivates me and what gets me excited, and some of the technologies that we're actively looking at. Geothermal is one that I didn't mention. We're actively looking at that as well, and you'll see some posts on that. So I would say the best thing to do is to keep monitoring our website for blogs, LinkedIn, definitely. And then reach out. Let's talk. I think that's probably the best way.
Excellent. Paul Burgon, everyone. I'm so glad to have him on the show today. Look forward to having him back on both of these subjects, as you can tell, are definitely in the wheelhouse for me in the family office community. I would like to do more on family businesses, on exits, on buying blue collar businesses. And those are all things that we look to be more active in, and things that I actually literally have an interest in myself in terms of what I do. And go back and look at some of my past content. We didn't have time to get into it today with Paul, but I covered ESOPs with one of the true thought leaders globally. We've covered a mini masterclass that I shared with members about a year ago on buying and selling private companies, and some of the conversations and things we had today. What are two of my other conversations with Ram Alawalia and others. We're on creating your own kind of mini Berkshire Hathaway, structuring a holding company. So these are definitely, not everything needs to revolve around AI and technology, although inevitably that's where the world is headed. But in the meantime, there's other incredible businesses and opportunities. And we do want to be diverse in terms of what I cover, not just what I may personally have a passion on. So it was great to have Paul on today. Everyone, you could follow me at angelorobles.com. If you're a qualifying family or family office, you got to become a member. Go to membership and join. Be building up towards 100 committed members that get proprietary intelligence, knowledge, access to me, connecting the dots, and really most importantly, and Paul hinted at this a while back, connectivity with incredible peers face to face. From Jackson Hole to LA to Las Vegas, I hope Utah, Miami, Palm Beach, New York, Greenwich, Vienna, Cayman Islands. We are a very active bunch, very intimate, not big. If you want big, a couple hundred people in a room, I am not the right fit. It's intimacy and very, very deep dives into things that are going to be very important for you. And great to be able to introduce you to incredible guests like Paul, and hopefully favorably so, and occasionally in person, especially when we're out on the West Coast. So you all know how to reach out and follow me at Family Office on YouTube. I'm active on LinkedIn, and go to the website, angelorobles.com, and learn more. Paul, I appreciate you very much. Look forward to the next time. And thanks for being our special guest today.
Thank you very much, Angelo. It was a pleasure, and I look forward to doing this again.
My pleasure, Paul. Thank you.
Thank you very much.